all signs, like I said, point to a strong second half of 18, at least a strong first half of 19, and after that, we don't know. And that's kind of what we're telling our clients at this point. There's some cautionary signs that we're watching. The first is that baby boomer shift. If it continues on pace right now, where we have some of the younger baby boomers continuing to acquire companies, I think the market can sustain the flood of businesses that will come on the other end. But if supply starts to outweigh demand, then we're going to see a suppression of value. We're going to see days on market tick up. We're going to see a lot more seller carry. It's just going to be, there's a lot more from the buyers to choose from. The other thing we're watching very closely too is interest rates. So a lot of the deals getting done right now are through debt financing, and with interest rates ticking up, that's going to make us figure out how to restructure deals a little bit as the loan costs go higher. We were meeting with some of our SBA lenders, and just in the last year, the SBA acquisition loans have gone up anywhere from 0.5 point to 1.5%, depending on the lender, which isn't super significant now, but it is something that we're watching. And the SBA program for Main Street and lower middle market has been crucial in getting the number of deals done that has happened in the last 5 years. During the recession, I think 20 or 30% of the deals were financed through the SBA 7A program. Right now, we're looking at like 60 to 70% of the deals are getting done through there. So it's a very significant source of financing for buyers. And if that cost of lending goes up, we're going to have to either adjust the values on the businesses, buyers might have to bring more cash, or the sellers might have to carry a note that's subordinate to the banks. So there's a lot of ways that could work. But ultimately, I think it's going to result in some suppression of value too. So we're watching the baby boomers and interest rates really closely to see how that's going to affect transactions moving forward. But I think ultimately we're still in a very strong and healthy market. Our advice typically to our clients right now is that if you're in that, I think I want to sell in 1 to 2 years, it's time to stop waiting on the sidelines. It's time to jump in, because we can be sure that we're in a good market right now, but we can't be sure that we're going to be in as good of a market 1 to 2 years from now. So that's our advice to clients. People that are further out, like 3 to 7 years, continue on your growth path and figure out what the best time is for you. But if you're in that up to 24 months period, now is the time to get in.